robot, and then we'll get started.
Access to this webinar is for educational and informational purposes only. Consult a licensed broker, a registered investment advisor before making any trades. All securities and orders discussed, tracked, and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, CSW, nor its affiliates, nor any of the respective officers. Personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involve risk. Visit the OCC website www.optionsclearing.com to read characteristics and risks of standardized options. The SW provides education and training services that are meant to teach you to the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are typical and are only valid on a specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone.
Fantastic. I, for one, am all in favor of machines taking over all my jobs. All right, let's see. How does the market look at the moment? Ooh, what the hell? Wow. There I was not paying any attention, and look what happened. Oh, my God. That was terrible. I thought it was getting better. All right. Wow. I, for one, am shocked. Holy cow. All right, let's see if we can, what if I split screen this thingy? That's not going to work. Damn it. All right, anyway, so this morning, first things first. Now, keep in mind that this chart, these numbers, where are they? Blah, 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 blah. Okay, here's our bounce lines. We talked about these bounce lines. Whoa, what are you doing? Stop that. Okay, here, this is the article I'm talking about. In this article, which says Wednesday weakness, blah, blah, here we go. And now, oh, wait. No. There, now I'm going to be able to do it. Watch this. This is going to be fancy. Ow. Now I can't bring up the thing. In this article, there we go. Okay. So, this is 2 weeks ago. I want you to understand how important the 5% rule is, okay? 2 weeks ago, on Wednesday, and we had a webinar that day, so you can go back and look at that webinar too. We put up the bounce lines, and the bounce lines were 18,075. This is off of 18,000. So exactly what happened 2 weeks ago. We fell, we hit the 18,000 line, we bounced. The bounce lines are 18,075 and 18,150. So here you go. Down, up, here's 18,075. And you can see how on the way down that was kind of a pause, right? And then 18,150. Now we're being rejected at 18,150. On the S&P, it was 2134. We're at 2134. We're getting back to 2134 now, and 2140. And that was off 21. Now I know that since you see 6 points between it, so you just subtract 6 from that. So 2128 right here, and you see how nice that line is, how it holds up? 2128 was the bounce line. So we're in the exact same range we were in 2 weeks ago, doing the exact same things we did 2 weeks ago, which makes it kind of easy to play, right? It's a shame that we started the webinar now, because I mean it was kind of obvious we were going to get rejected here, especially because you ran right into, at the resistance point on the 5% rule, you also run into the resistance point on the pivot points, and over here too. These pivot points lined up exactly with where we predicted they'd be 2 weeks ago. NASDAQ, well, the NASDAQ's out of control, of course, because of a couple of stocks went crazy. So that's not really something we can look at right now as far as that goes. The Russell, on the other hand, the poor Russell. Now, don't forget the Russell and the S&P are two big, broad indicators. So, because they're on the New York Stock Exchange futures. And the Russell with their 2,000 stocks are underperforming. Okay, so a week, again, if we say this is 6 between them, right? So he must have been at 12220. So 2 weeks ago, 12220 was the line we held. Look what happened today. 12220 was the line we failed. And where did we fail from, right? 1232, that's the bounce over there. So the Russell went up faster to its strong bounce line, but failed the strong bounce line. It gave us a nice early indicator that strong bounces weren't holding. And there. And that's why we like to play the Russell. That's why we like the Russell the most. In fact, I played the Russell on Monday short, but I didn't stick with it, unfortunately. You have a nice additional drop to that. So it's the same crap over and over and over again. It's fun to play, but it's not exciting to talk about. It's just like, okay, sure. So they bullshit the market up. Then it gets back to a level where the funds start selling. Then more idiots come in and buy it. Then the funds start selling again. That's why you have money outflows, but the market stays up because they always find, like they say, there's a sucker born every minute. So there's always somebody new to buy some stocks. There's always people. In fact, my brother yesterday just called me on the phone because he's in cash, and he's upset that he's in cash because he's saying, "Oh my God, look, the market's going up again. So you said you'd be in cash. Why don't we get out of cash?" I said to him, it's my older brother too. And I said to him, "I'm like, look, it's still not safe." I said, "Why do you want to get?" I said, "What's your upside from here?" And I said, your upside, look at the NASDAQ. The NASDAQ's at 4,900. You know you're going to get rejected at 5,000. It's like a fact. Okay, so your upside from here is 2%. You're basically a 2% upside before you run into 5,000 on the NASDAQ, which is extremely likely to get rejected, and rejected by at least 2.5%, so you're going to come right back to where you are now. So I said, at least wait until you see 5,000 before you start telling me the market's going higher. That's number one. Number two, I said, yes, the U.S. is improving, but China's not improving, Japan's not improving, Europe's not improving. We can't carry the entire world. And I said, and the point being, though, that you have 2% upside maybe if you start jumping in now on things versus still a 10% or more downside probability, not even a possibility. It's more likely we have a 10% drop than we have a 2% gain. So if that's what the game is, it's like playing Russian roulette where you put 5 bullets in and leave 1 hole, and then you spin it and go, okay, let's give it a shot. That's not the way you gamble. It's not the way you invest, for sure. It's not even the way you gamble, though. It's like it's a terrible bet. There's not enough upside to justify putting a lot of money into the market right now. Okay, you better off keeping dry powder, waiting for things to go on sale, especially at earnings season. Everything goes on sale. Look at these deals we're getting right now with Chipotle and stuff like that, and Sonic. We're getting good stocks that are going on sale, and their PEs are going. The S&P's overall PE ratio right now is like 28, 27, and you can pick up these stocks like Apple with a PE of 13 or 12. So why don't we buy those instead of buying the ones that have PEs of 27, 28, 30, whatever? It's just logical. I mean, if you're going, and again, I'm talking as an investor. I'm not trading. I'm not looking to catch a trend and things like that. I want to invest for the long haul, buy stocks that I'm comfortable keeping my portfolio, even if the market has a sharp correction. All right, so that's my opening statement. Let's see, where are we? Okay. Naomi, I hope you heard me. Okay, we were talking about before. Did you hear me? When was I saying that? I'm so confused now. Anyway, stocks. In natural gas, see, the thing is when you're trading futures, energy, 5 minutes, natural gas. Okay, well, I guess not evident here. Maybe it'll show up on this thing. Let's see. Charts. That thing. Okay. Here we go. So NG. Yikes. What kind of time frame is that? A day? 5 days, 5 minutes. Okay. Oh, it wasn't natural gas, it was oil. Oh, I assumed it was oil. Here you go. Okay. So here's the problem. When you're trading oil and you trade into an event, or any commodity, doesn't matter what it is, you trade into an event. Here's a 5 minute. Let's see if we can get a 1 minute thingy. 1 minute. Okay. So here's 1 minute. So you're trading here and you have a stop here, let's say, or whatever. Assume this is instantaneous. There was a bid at 48.88, okay? And then a second later, because the report comes out, the next bid is 49.57. It doesn't matter that you have a stop here. Nobody actually wanted to pay you that money. Okay, because the new information repriced oil at a level that was way past your stop. Unfortunately, though, with your trading system, well, it depends on your broker, I suppose. With a lot of trading systems, they're not going to fill the order up here. They're just going to leave your order to sell, to stop out at this price, and it has to come back to that price before it'll stop you out. Okay, it's not going to, and frankly, you don't want it in general. You don't want it to fill on some stupid spiky gap for exactly this reason, because look what happened. It spiked up like crazy, and now it came back down. That's the bottom line. That's why with futures, if you can't sit and watch it, don't play. Just get out, get back in when you come back from whatever you're doing that you couldn't watch it. And that includes going to the bathroom. Because you just can't walk away from futures contracts. They're just way too volatile. And especially if you know an event's coming up. I mean, that's just kooky. All right, so there's that one. Oh, you say got it. I guess you might have heard me before. I don't even know. All right. Houston, Dallas. Okay, okay. Stan says Tesla. He has a short Tesla using 2018 options. What's the best way to neutralize the earnings? Just buy the stock or more exotic? Well, it depends on what your options are short. Look, we have I think, in the short-term portfolio, oh, here it is. In the short-term portfolio, we sold the 250 calls back in August. Now, we sold them for $475, and now they're $234. But they're $50 away. I am not going to buy them back. I'm willing to bet Tesla's not going up 20% between now and January. Okay, I don't think there's really anything they can say in earnings that's going to cause that to happen. I could be wrong. You never know. Who knows? I mean, if they pull up another quarter like last quarter, then people are going to start thinking that for real. But I think last quarter shipping was bullshit, and you'll see a big reversal this quarter that'll let people realize that. Anyway, so honestly, if you've got a 2018 position and you're short, neutralizing means betting against yourself, right? So if it goes well for you, you're going to lose a percentage of what you would have gained. I think, frankly, I would just hold the position unless it's more than you are comfortable losing if Tesla moves 10% against you. But if you can take a 10% move and just adjust it after the fact, I would just stick in the position. You have to have. If you don't have the conviction of a position, you shouldn't be in it. I mean, because think about it. Let's say you hedge and spend 10%, 15% of your long position, of your potential long gains to hedge this earnings. Then you got 3 more earnings ahead of you, 3 or 4 more earnings before your options come in the money. So you can spend 30, 40, 50% of your potential gains on hedges, betting against yourself. That makes no sense. So you need to decide whether you believe in your position or not, and don't be in a position you don't believe in. I mean, I hedge the market. Okay, we hedge the overall market because we have so many bullish positions and we want to hedge the overall market on a sharp drop. But if you start taking each position you're in or any position you're in, and hedging that position, you're guaranteeing you can't win. You're guaranteeing that you're going, you're taking money out of your own pocket. No, even if you're going to, if it goes your way, now you just blew that money. With the market hedges we have, sometimes, in fact, it's happened very often. Is what happens. The market goes down. We cash in our hedges because we feel it's stabilizing. We make money on the hedges, and the market goes back up, and we make our money on our stocks again. All right. I mean, what's your fear? Your fear is Tesla's going to go up. So what would you have to do? You would have to buy a short-term bull call spread or something like that would mitigate the damages on the way up. But it's still going to cost you money because once Tesla's earnings come out and it doesn't hit them and it doesn't hit that point, then you're in trouble. I guess if I had I don't know what you have again, but if you have a 2018 position that's bearish, and let's say for example TSLA. Okay. So let's say you own a 2000. And by the way, people, if you want real answers, give me real numbers and real positions. If you own a 160 put, or what? Let's say you own a 160 put, and it's $20. Okay, 2018 160 put. So you hope it doesn't go up $20 because if it goes up $20, then your 160 put will be worth what the 140 put is, which is 13. You'll lose $7, right? So your fear is you lose $7 on a 10% move in the stock. So what can you do? Well, one thing you can do is you can sell the current 160 puts, the January 160 puts, for $350. So that's about half of what you'd lose if it goes up. Obviously, if it goes up, those puts will become worthless. And if it goes down, you're going to be you'll make $7, $8, and these things still won't be in the money on a $20 miss. And if it drops $40, then your puts will be worth, the 160 puts will be worth what the $200 puts are, which is like $40. All right, so you'd make $20. So you make $20 before these things go back in the money. And then below that, it then starts chewing into your gains, your potential gains. But it doesn't hurt you. It's still going to make you $20, probably more so than the long. So, that's how you would hedge it if you wanted to hedge it. But again, it's a reasonable way to hedge it because you have the time value and so on and so forth. And if Tesla goes down, but not too far down, you still win. If Tesla goes up, then you win. So there's a lot of ways to win. If Tesla's flat, you win. So that's how I would hedge if I had a long put position. And again, don't overhedge. You only want to mitigate the damages, not erase the damages. Because if you start erasing the damages, then you're totally betting against yourself. So I hope that made sense. That's just a good general rule about hedging. So hopefully people who need that. UNG. Who asked about UNG? Somebody asked about UNG, didn't they? What's going on with UNG? That's right. So many people ask it, I kind of blew past it. So UNG is the natural gas. It just got ahead of itself. Our target was for $3 at the end of this year. So here we are at $3 again. We didn't think it was going to go up the way it went up. We were playing it from here. So we were playing from like 260. It was actually 250. This is a different contract, but when we were playing it, it was down around 250. No, I'm sorry. I'm not even right about that. When we were playing the contract originally, they were under $2 early this year, for the short-term natural gas contract. We played them since $2. We targeted $3 for the end of the year. We don't give a crap about what term contract it is. We targeted $3 for natural gas at the end of the year. It started flying here in June. It went crazy. Now, possibly because I went on TV and ticked it. This is exactly when I went on TV and told people natural gas was a great play. I had previously said it, but I was on this other big show when I talked about it here. And then, in fact, two weeks in a row, I went on TV and talked about natural gas. Anyway, so I don't know if I caused it or if it just went up on its own or I just had great timing, but whatever. The bottom line is it went flying up. Like we were like, oh, screw it. At 320, we basically got out because we were like, oh, that's way too high. We took the money. We didn't short it though, and then we got back in here. We had a little ride again now, but since up here we haven't even been in it except for the UNG. Now it pulled back tremendously. Why did it pull back? Well, here hurricane season ended. It didn't end really, but the forecast hurricane season runs to like the first week in November, but by the middle of October you have your forecast for the first week in November, and there were no hurricanes forecast. And if you're not going to have a hurricane that shuts down production, then you're going to have a big glut of natural gas. Number one. Number two, the weather is, it's funny. I used to say unseasonably mild is kind of silly when it's always unseasonably mild. The world is warming up. Okay, therefore you don't need heating as soon as you need it here. And now again, that's causing the 90-day forecast here. AccuWeather. I'm going to show you this stuff. We talk about these things a lot, but I just want to show you a couple of things we actually look at when we're figuring, we don't just pull it out of our ass. So here's AccuWeather. Come on, Phil, you know where these things are, don't you? Yes, radar and maps, isn't it? Hello? Forecast maps. Yes, I found it. Forecast maps, trends. Here you go. Okay. So there's your 90-day outlook compared to normal. Oh, wait, that's precipitation. What? Oh, man, that's weird. Okay, usually they have it. I'm sorry. Anyway, but, pretend this is a 90-day outlook. I'm sure the 90-day outlook. Oh, here it comes. Okay, so the 30-day outlook, this is not good. Okay, there's nothing cold. Everything this is above normal temperatures in a large chunk of the country, above normal here, above normal here, above normal here, all above normal here, all above normal here. In the 6 to 10 day, we're way above normal. So there's no need for natural gas. Now, there's two problems. Nobody's heating their pools because everyone shut down their pools by now after Labor Day or whatever day that was, Memorial Day. No, Labor Day. Okay, so after everybody shuts down their pool in September, that way. So there's no more heating the pools, and then you wait for people to put their fireplaces on and put on their and start heating their homes, and that brings demand back again. That didn't happen. So you have no hurricanes, no demand for heat, even going out 90 days, which is November, December. You're into January, and honestly, it's only cold in the places where it's usually cold. So that's really not thrilling. They want to see this area. They want to see the Northeast be cold and blue. Okay? And not even precipitation. We're also not even getting snow or anything like that. So it's really not good for the outlook. So between that and not having hurricanes and the fact that the natural gas got way ahead of itself, we're back. And also seasonally, this is what happens in this part of the season, because this is the maximum. This is always a time when storage maxes out. So we could go much lower than this. Don't think this is the end. And it doesn't negate the fact that we like natural gas for the 2018 longs, but unfortunately, this interim, we're going to get, it's just got to ride out. Now, we're excited. We want to get back in. If $3 starts holding up, I'm going to want to go long at 3 with a stop below it, but probably we think we're going to get down to like 280 again. Because of the rate of this decline. We had a 5% drop yesterday. We have another 5% drop today. And as you can see, we had pretty much a 5% drop the day before. So 5, 5, 5. That's not the kind of thing that's going to stop. You'll be lucky if tomorrow it only goes down 2.5%, and then you'll be lucky if it starts diminishing to the point where 280 holds up. Otherwise, we'll see 260. But if we see 260, I'm like, buy. I wish we had more UNG. And we will have more UNG if we get back to 260. I mean, it'll just be a great trade again, just like it was a great trade last year when we were down at this price. And like I said, 260 is the relative, because at this time last year it was really under $2. But this contract is a much longer term contract. It never went down that far, because when the short term contracts were under 2, this contract for a year from then was up at 260. Okay, but I don't think the short-term contracts, this being the short-term contract now, I don't think the short-term contracts are going to go much below 260 now. So we've made a tremendous, even though it doesn't feel like it, we've made a tremendous progress from last year to this year. We're up 30% from last year on natural gas prices, and will continue to go up another 30% next year into the 3+ range. We may even hit 4, though, at some point next year. We almost hit 4 here. But that's why we took the money and ran. We took the money and ran in July. When we got up here, we were like, this is ridiculous. Let's get out of this trade. So we cashed a lot of our stuff back then. Okay, so now we get to Brian's particular UNG issue. He sold the 2019 $8 puts for $190. He bought the $5 calls for $4. Wait for short calls or fill right away. Yeah, well, bought the $5 calls for $4. That was a very aggressive buy. So you should not have done that. If you're buying an in-the-money call, you may as well own the stock. And again, I'm not saying you should own the stock, but I mean, you may as well be owning the stock. So to not cover the $5 call is not a good idea. Apparently, you just did this trade, though, so that's okay. All right, so what would I do? Here's what I would do. I would cover 1/2 of the 9s at $2, but try to get $2 for the $9 call. I would cover 1/2, because here's the two things that are going to happen. Either natural gas bounces up here, and you will either cover more at a higher price, like $3, or if it really flies up, you can then roll these calls to a full cover of something much higher. You see how the 14s are like $1, or at least the 13s are $1? So there's no mistake here. So the worst thing that happens to you is if natural gas flies up, you can roll these calls, a half cover, to a full cover of the 13 calls. And having a 5-13 spread is gigantic, so there's no hassle there. If it goes down, then you can cover you can cover the rest of the $8 calls, and they'd be like $3, right? So then you're still going to get, so you get 2, and then you get another maybe $2.50 for the $7 calls. If we start going down again, then you've got a full cover. You've sold an average of like $2.25, and you can use that money to roll yourself to a lower strike when and if you have to do that. All right, but if not, then you still have a reasonably priced spread because you only paid $4 and you sold more than $2 worth of calls. All right, so you don't want to get yourself in a position where it can turn out really badly for you. So at least you want to do a half cover of the 2s so that way you knock your basis down to $3 at the worst. Okay, and then that's easy to knock it from 3. Then you can easily knock it down to 2 on the rest by selling some more stuff for 2. But don't leave yourself open to that kind of damage. That's what I'm saying. And yes, you're looking at the 10s. Don't look at the 10s. Half of the 9s is better than full covering the 10s. Don't try to guess when something is this much in flux. This is a really nasty move. It could easily go down more than we think. Oil's going lower. Well, oil. I guess the problem with the oil. Let's take a look at that. We should. Petroleum status report. There you go. Oh, I looked at the wrong one. See, here's the thing. This is the 1030 report. I'm now acting like I meant to do that. This is the 1030 report. It doesn't give you much information. It's just this one page of paper that kind of tells you this is what happened. But then at 1 o'clock, we get the good report, which is this. And what was that? Control Plus? And it says the same stuff on top, but here's where you get to look and see what happened. So we know last week the imports were severely down. They were down 1 million barrels a day. They're even lower now. Okay, so we're actually importing less. This was last year, but ignore that. We were generally importing 8 million barrels a day until last week. It went down 1 million barrels last week. It's still going lower. So in other words, this inventory build, the drawn inventory we have here, See, here's the funny thing: because unless you keep track, you don't get it. Because it says they were 7 million barrels a day, up by 109,000. I think they're talking about the net total here, up by 109,000. But the reality is, the actual product of imports here is what it is. Oh, and look, we exported 200,000 less barrels of gasoline per day. So there's a 1 million barrel building gasoline just because we exported less of it. All right, so you got to be real careful of that kind of stuff. And here's so what the inputs were about the same. You look at anything funny that seems to be a big change that doesn't make any sense. So these guys are okay. You have this all other oils drew down a bit. Distillates were down. Motor gas was down, but of course, motor gas is down at 200,000 barrels a day less exported. That means that we exported less, so there should be more. But there isn't. That's interesting. Okay, actually, it's not right. So here's 1.4 million barrels less exported, yet still we drew down quite a lot of gasoline. So it's hard to figure out where this all went. The overall supply is down from 35 to 26. That's 9 million total barrels of drawn supply. So it's actually it's a bullish report. But I guess it's still not bullish enough to hold 50, which is surprising. It's actually a pretty bullish report. All other products. So what was supplied? All other products. That's all other oils over there. So there was a good supply of all other oils. Distillates, they cranked up the distillate supply. They cranked up the gasoline supply. Yet the inventories went down. Why would that be? I wonder if, like, the hurricane disrupted. How bad was it? I was watching the news. I guess it was kind of floody. I mean, you think about the fact that possibly there was a lot of deliveries that didn't come through, so a lot of gasolines in that area might have run out of gas, and they were all, like, calling in orders to fill up their tanks. So that might be where it is. See, that's the thing. When you look at gasoline inventory, don't think about the cars driving all of a sudden. Think about, like, the gas stations and what they're doing. So it's possible that after the hurricane, all these East Coast gas stations, over the course of the hurricane time, they ran out of gas. And so they're all calling the fuel trucks to come and fill up their tanks. That doesn't mean the gas is being used. It just means they're all filling up their tanks because they ran low after the hurricane. Kind of like after a holiday weekend, that sort of thing happened. On the whole, though, this is not a very bearish report. So it's interesting that we had such a drop in oil. So I would look for another cause besides that. Why did we get on that topic, though? Anyway, okay, oil. Chart. So this is weird. So this seemed like the correct reaction. It should have gone back to 50. It didn't hold 50. So there's a different reason that oil's coming down. And it's not just because the dollar bounced this tiny amount. That's not causing it. And look, gasoline's down too, and they have a good demand. Natural gas tank is in the crap, but we know that. Silver. Nope. I honestly can't tell you what's exactly causing this. It's interesting. So more reading is required. That's all I can say about that. Wells Fargo strategy. Stay away from them. They're getting sued. They're getting fined. They're losing customers. That's my strategy. Is we never liked them that much, and now they're in trouble. I mean, they're bouncing because people. You have all these TA people who go, oh, it hit this thing, and this is the resistance line, and as you can see, if you draw it back like that, and if we draw back here, we see that back in here in 2014, they hit this line, they bounce back to here, and therefore, blah, 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 blah. No. Okay? They fell this year from 55 to 40, whatever, 45, forget this, 45 is probably the right price. So they fell from 55 to 45. The bounce from 55 to 45, it's $10 drop, so the bounce is 2. And that's a weak bounce, and then a strong bounce can be 4 to 49. So let's see. We have 55 to 59 to 45. We go back to 47, up to 49, and back down, and then back to 49, a little over and back down, and back to 49, a bit over and back down, and then back to, now here's a nice spike, and we thought we were going to get a good one there, but then, oh, scandal. Or I don't know if there was, or maybe the early part of the scandal, whatever. At this point, it was a scandal. But then we get on a nice run, and then all of a sudden, big scandal. All right? Now, let's not forget that all these earnings, going back and back and back and back and back as far as you want, they're fake. They pumped up their numbers. They faked money is money. If money came in, they had some earnings. But they faked the accounts. They stole money. They did illegal things. They're a bad bank. Why would you want to own them? And I don't mean morally. I'm like, they did bad things and they got caught. Okay, I'll invest in Jesse James while he's out there robbing banks. Okay, but once he's caught and they got him in handcuffs, I'm not gonna buy him as a breakout stock. I'm not gonna be like, oh well, he'll get busted out of jail and he'll go back on a spree and we'll start making money again. I'm like, no, you know what? He's in jail. Let's wait till he gets out of jail. So that's what you should be thinking with Wells Fargo. Okay, they got caught. There's a huge amount of customers leaving them. My play on Wells Fargo, which we talked about earlier in the week, is to buy Bank America. That was our play. I think I talked about that on Monday, didn't I, guys? My play for Wells Fargo is buy Bank America. And let's see if I said that Monday. I'm pretty sure it was Monday. Unless it was Friday, I don't know. Very bad to play stocks that have common words. Oh, well. Nope, not 10. Oh, well. I know at some point we had this conversation, and I said, look, Bank America is a good play on Wells Fargo because they are benefiting. It must have been the weekend then, right, guys? I had charts and graphs and all kinds of good stuff. So, it must be the weekend because I know I put some time into that one. That would probably put it here. Control F, B, A, C. No, seriously? I don't know. I remember a whole discussion about it. Maybe I should look for Wells Fargo instead. WFC. No. And it wasn't Monday. WFC. No. It wasn't yesterday. Was it? All right. Well, you've eliminated everything else, Sherlock Holmes says. Then it must be the other thing. I would think I would remember if I was talking about it yesterday, though. Oh, I talked about it in the post. Jeez. It wasn't in chat. It was in the post. I'm so embarrassed. All right, so yesterday, you should be embarrassed. You asked me a question I talked about yesterday. So here's the thing. Impacted Wells Fargo to gain on its business, okay? Year-over-year decline. Meetings with branch bankers, 10% down. Credit card applications, 20% down. Checking accounts open, 25% down. 14% of their customers have decided to leave. Where are the customers going? They're going to Bank America. Okay? That's where they're going. They're going to Citi and they're going to Bank America. I like Bank America better than Citi. So that's what we liked. And then we had a, did we talk about what the trade would be? Blah, 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 blah. What happened here? Oh, buying Bank America at 1677. Okay. Oh, I see. Because yesterday I just said buy Bank America. I didn't give a specific play, and then maybe I didn't give one later. I might have forgotten. Yep. That's what happened. All right, now I'm caught up. All right, so thank was your Tuesday post. Okay, thanks. Now I'm catching up. All right, so anyway, so what would Bank America play be? Let's just call it that. So for those reasons, that's my Wells Fargo play, the Bank America play. And Bank America, they pay a dividend. I forget what the dividend is. Let's take a look. BAC. Dividend is, what did they do? They changed Yahoo again? Anyway, dividend. Oh, that's crap. Okay, so forget the dividend. No reason to own it. All right. So, Bank America pays a crappy dividend, so there's no reason to own the stock itself, but you can. But the nice thing about it is, 1683. You can sell the 2019 $15 puts for $1.87. All right, so that puts you in at net like $13.13, right? So $13.13, obviously a significant discount from that. It's almost a 20% discount off that. So that's nice to start with. And then you can pick up a bull call spread if you want to be more aggressive. It's just perfectly nice to have that, though. You're going to make $1.87, which is 10% of the stock's price, and you don't even have to own it. And the worst thing that can happen to you is you own it for a discount. So that's a nice risk-reward play. But if you want to be more aggressive than that, you could pick up, let's say, the 15s, which are $3.50, and you can sell the 20s, which are $1.30, and $3.50 minus $1.30 is $2.20. Okay, so $2.20 minus $1.87, or let's call it $1.90. So $2.20 minus $1.90 is a 30 cents. So you'd be in here for net 30. You sell the 15 puts, you buy the 15 calls, you sell the 20 calls. The net on the trade is 30 cents of cash. Your obligation is to buy Bank America at 15 for a 10% discount. So your worst case scenario is getting Bank America for a 10% discount. Worst case. Best case scenario, you're going to make $4.70 on the trade. Now, how much margin is required to do this? If you sell 10 of the puts for $1.90, what are we getting hit with? Your margin is only $1,151. That's to sell 10 of these puts. So for $1,151 of margin, you get to have this spread, and it pays up to $5,000 if all goes well. You have a $4,700 profit. So that's what we call margin efficient. That's a great margin efficient play. And like I said, the risk reward is fantastic. Your worst case is you own the stock for $15 plus the net 30 cents that you're putting in on the spread. So $15.30 would be your buy price, which is $1.50 below the current price. Now, looking ahead, if you own Bank America, if you're forced to own it for 15, then what do you do? Well, then you look out to 2021, and you sell the $15 calls for $3.50. So you have the stock forced to you at $15.30. You sell the 15 calls for $3.50. That drops your net to 12 right there. Okay, without even selling the puts. And then if you're willing to buy more, you could sell the puts. You could sell the 13 puts. You don't have to sell the 15 puts. You can sell the 13 puts. You can sell the $10 puts. Or you can sell no puts, because frankly, if you knock your net down to 12, that's a pretty good knockdown. It's a 20% reduction in your price. So you're not really agreeing to buy Bank America 15. Plus, you can always roll the call too. So let's say you sold the 1750 calls of January, right? Or let's say you sold the 18 calls. So the 18 calls were $1.50, or whatever, are $1.50. And then if you come to 2019 and it turns out that the stock is below your calls, so the stock has to be like 13.81 for this to happen, but the stock was 13.81, your $15 calls were the same $1.50, then what would you do? Well, you just roll it along to the $15 calls, to the $3 lower calls 2 years down the line. So in other words, every 2 years in this stock, you can save yourself 20% by rolling. Well, if you can save 20% every 2 years by rolling your short puts, then that means that in 10 years, you'll have zero. So unless Bank of America goes bankrupt, you have an extremely good chance of getting out of this trade without paying any money, no matter what happens. That's why I love these kind of trades. You just roll it along, but you have to think of it as a long-term thing. Your worst case, if you're stuck with this $1,100 margin year after year after year, and you just keep rolling the short puts until you finally find a year where they manage to hold up. That's your worst case. Your best case is you make $5,000, right, in 2 years. It's good odds, right? That's how you got to play these things. All right, so Wells Fargo strategy, right? Look at that. Moving on. Sonic. Never filled. Okay, well. Sonic. Well, my thoughts on these rolls are you guys keep putting in for the roll, which is silly. March 25, March 22.50. Okay, right. So you have to play the thing a little bit. Here, look, here's Sonic. So since the drop, or since yesterday, well, yesterday we said we're going to do that, right? Since yesterday, it's been at 21.50 and 22.70, and now it's back to 22. So everything would have filled if you put them in separate orders. But if you put it in for the spread as a roll, your broker won't fill it because there's no money in it for the broker. They can't make a nickel if you're calling for the net of the spread. They can't make any money, and if they can't make any money, they don't like to fill the trade. So they go on. They fill all the profitable trades first, and then they'll look at yours. So you're talking about the March 25. Wait, March 25 to the 22.50. So the March 25. And I'll show you in a second, show you exactly what I mean. Where are these things? Analyze? No. Trade? Forex. Charts. Flexible. Here we go. Okay. So let's find these. I'll show you how you can check this stuff. The March 25. Oh, it's not Sonic. SONC. So here's the range we're in. The March 25, copy. So I copied. I'll show you through it slow next time. Here's the March 25, and here's. Damn it. So all I'm doing is go to the 2250s. I right-click on it. I say copy the code of Sonic. Then I go to the charts, flexible grids, so I can have just two charts. Then I paste the code in here, and it's going to show me the chart of Sonic. So, as you can see, in the last 2 days, we've gone from 312. Whoa, okay, I'm sorry. Since it was 80, it was down as low as 54, and as high as, well, I don't know what that is. I mean, for some reason, it spiked up like crazy. But it went from 54 to the 70s, and then it was as high as 80. The target went from, let's see, line this up here. Okay, so when this was 54, this was 123. But what I'm saying, it doesn't matter. It's not the same time. The point is, you offer to sell for the price you want to sell for, or I'm sorry, to buy. You offer to buy for the price you want to buy for. So you're looking for a low price here So you could have gotten it for 140 here, you could have gotten it for 140 here, you could have gotten it for 145 here, and here you could have sold it for 75, which is, in fact, that's exactly what we were looking for, 75. Here is 66, and here's 80, and here's 75, here's 85, which just happened. So, the point is you offer a price on one side and offer to sell on the other side at the prices you want to get. Don't ask for the spread, because in order to fill the spread, both of these things have to line up exactly where you need them to be at the exact same time. Otherwise, you'll just never fill, and it'll keep drifting along. And the market makers, the guy's got zero. The guy who's doing this for the brokerage, the guy on the other end, or the computer program, if it's a computer program, still is programmed the same way. It's programmed to make the broker money. So if they can't have a little advantage on both sides, they're going to put you in the back of the line behind people who are putting in limit orders and open orders and such, and market orders. Look at this one though. What the hell happened there? That's incredible. I don't know. I mean, how would somebody suddenly pay $5? That is completely kooky. Anyway, but the moral of the story is there's tons of fills. It's just you can't tie your legs together so they won't fill anything for you. It's not a good way to fill, trying to fill a spread as a spread. It does not go well for you most of the time. If you're just sort of putting it in and saying, well, if it ever gets to this price, then I want to fill it, that's fine to fill it like that. But if you actually want to do something, if you want it to fill, and you want to move it in a short order, that's the worst way to try to do it. Wow, look at it, back to 1,200. Now that's a really tempting long here. But in absence of knowing what the hell's going on, I don't know why we're so far down now. SunPower, do you think it's worth covering the long calls in the OOP with short calls before earnings? Oh dear, really? Do we have SunPower open? I'd say yes. I don't have that much faith in it. Let me see. Well, they are beating the crap though, aren't they? We were hoping for a bounce. The bounce never really came. So the question is, here we are with our 2018 $8 calls. This is a toughie. Wow. You really got me on that one. I wish you would ask me that 2 days ago, because when we were at $9, I would have been like, oh yeah, let's cover there. Now we're back at 8. Oh, that's the wrong chart. PWR. Damn. What are we going to do about that? November 9th. Okay, we have till November 9th. That makes me feel better. It's not like an urgent thing. It would have been smart to cover when they hit 9. They really would have. If they do it again, we should. I will keep an eye on it. I would be, fortunately we get, hopefully we'll get some other solars in between, see how they're doing. But the bottom line is, look, they have $1 billion market cap, $1.1 billion market cap. The expectations by the analysts are, well, it's a wide range, huh? Some people think they're going to miss, they're going to have negative earnings. Some people think they're going to make 38 cents. The consensus earnings trend, here you go. The trend has been way down. Okay, so they were, at the end of last quarter, people thought they were going to make 80 cents. Now the average consensus is 38 cents. For the year, 133 to 30. So that's 30 cents per $8 share. That's not a very exciting PE ratio. Next year, not improving either. 50 cents per $8 share. Now, frankly, 50 cents per $8 share isn't awful. That's a PE of 16. That's not terrible, but we'll see. So, can things be worse? Not really, and that's kind of that's my what I call my sweet spot though. Things can't be much worse or unlikely to get much worse. And then you have to consider this also. How much SunPower do we have? We got 20 long. This goes back to that thing where I think I'd rather have a half cover. But let's see what a half cover is going to do to us. So SPWR, the earnings of November 8th. So let's see January. Let's see if the January 10th. See, this is the thing. If we sell the January $9 calls, we only can get 65 cents of them. It's really, and that's going to put a lid on us for only $1 worth of gains here before we get cut off. Now we could do, if we do a half cover, all we're doing is then covering 30 something cents per long. So the thing is, I don't know, at that point I may as well lose the 30 cents. I'd rather have more upside and risk losing the 30 cents because that's the thing. It's, the cover doesn't stop you from losing money. The cover only stops you from losing the amount of the cover, right? 30 cents of your loss would be mitigated by that. 30 cents is not much money. We lost 30 cents today, in fact, on the call. So 30 cents is not a very exciting amount, and if they beat, they'll probably zoom back up really fast, but then if we have a cover, we'll be like, oh, son of a bitch, we covered it. We're in it for the long haul. If it does go down considerably, here's the thing. Assume that these calls will drop to the value of those calls. So if they drop $2, which would be crazy, but let's say they drop 25%, then these calls, which are $2.20 now, $2.30, will drop to these, which are $1.65. Well, that's not bad. But then we could spend the 70 cents to roll down $2. So I don't consider that a terrible outcome. I don't mind being in the 6s or the 5s or whatever for another 70 cents to $1. I don't consider that a horrible outcome. Then we could sell calls. Then we could sell some long-term calls to pay for that. But I'd rather have the flexibility than lock myself in just because it's only in exchange for such a little amount of money. It's not worth it. And I know you can say, okay, well, why don't we sell the 2018 calls for $1? And it's like, well, no, because by 2018 we think we're going to recover. It's only short term that we think that there may still be some pain. So I don't see covering it for the short-term pain. But I will consider it in light of other solar earnings that we'll have to watch carefully. Okay. When you search for BAC or F search with a space before and after the letters BAC, really? Is that going to work? Okay, cool. All right, I will try that. That makes sense. You're right. $5 buy mistake. Somebody accidentally placed a bid instead of a sell bid and hit the place order. Oh, okay. Yeah, that's weird, right? I mean, but it's on 2 different contracts. They did it twice. They did it on both those contracts. Those were separate. Oh, that's you? Oh, that's funny. Okay, well now we know who did it. I'm like, why did that happen to both of them? It's such a weird thing. I mean, that is a freaky looking trade that went on there. Look at this. But that's our roll, okay? So it's right at that same time, right? So just that's the execution of the roll with these, whatever ridiculous thing happened. It's pretty strange. All right, at least you got a partial fill. And and don't forget, these are not emergencies, okay? We're rolling for position. If you don't get it, the only reason you wouldn't get the roll is probably because the stock's going back up, and if the stock's going back up, you don't need to roll down as badly as you did before. So that's funny, Lee. That's a weird way to fill it. All right, so what's going on? What do we say? We're going to check the news. I think we talked about that. See if anything's going on that's causing this horrifying market. News. What is this? Why does it not come out the way mine does? Market news. When I get little summaries here. I don't know what to do about that. All right. Anyway, so let's see what we can glean from the headlines. GM with a bolt. Yahoo makes sense. Comscore, Goldman, Semiconductors, Exxon declares big deal. Dragon Wave. Oh wow, we finally they're pulling it out. These guys were really getting beaten up. Merrill Lynch, Care. Here comes an IPO. What's that, Aramco? I say Aramco. No, ZTO. Who the hell are you? Oh, shippers. Pandora bad. What? That Apple thing is killing them. Textron. JP Morgan warns on Lowe's. They have no hurricanes, so no good news for them. Bernstein Saws. Oh, now this is important. Bernstein Saws is up the railroad sector. Outperform, market perform, market perform, market perform. Okay, so they're not seeing anything. That's good. So shipping's not so terrible. Not that it's been at all good, but at least it's not getting worse. Microsoft upgrades the Surface, but I don't even understand what they're doing. Honestly, I see this new Surface, not Microsoft in particular, but like the touch things are getting weird. Like the way they're making their new Surface, it's like those table computers that people have, where they, Microsoft is in love with this concept that like you're going to do these space age sort of motions with your hands and things are going to happen, and I don't know. I'm old. I can't relate to it. I like a mouse. I click and I'm done. I get, I'm just never going to be comfortable, like doing the Tony Stark thing, like in Iron Man, he's motioning with his hands and like things open up and he flips pages. It's too weird for me. I'm not sure I'll ever get used to that kind of stuff. Auto sales forecast to fall 7% in October. Ow! Is that what killed the market? Ha-ha! 1241. Now we have a clue. Trade? No. Charts. Time? When did this happen? 1241. There you go. Okay. Now we know what happened. Everybody freaked out about auto sales. So now we have to think, what do we think about the fact? Vehicle sales will fall 6.6% in October. The forecast doesn't adjust for fewer selling. Oh, people are so funny. The forecast doesn't adjust for the 2 fewer selling days in the period this year. Hurricane Matthew was also a negative sales force during the month. Wow, seriously? So there are 2 fewer selling days, and there was a hurricane, and we fell 6.6%. How many days are in a month? 30 days are in a month. What's one day out of 30 is 3%. Therefore, 2 days is 6%. A hurricane, also a little bit of a mitigating factor. Holy crap. Oh, my dear. This is unbelievable. Ford, blah, blah, Honda holding up better than most, Kia holding up better than most, Nissan holding up better than most. So all these Japanese companies, I guess probably because the exchange rates are so good, they're doing well. Toyota. Hey, where's Toyota actually? That's interesting because I love Toyota. Are they cheap? Toyota, whenever Toyota's cheap, I like to buy them. No, not cheap. Because Toyota and Honda have a bonus of like being in the robot division. Toyota and Honda have like nice robot division. So as a long-term hold, you really want to own companies that make robots. There are going to be robots everywhere. It's going to look like that movie iRobot. Like where robots are like running around doing grocery shopping for people and being slaves in the house and such. That's the future. I mean, it's a long, 20-year future, but it's as much cars as they make, these guys are going to be making robots in 20 years. So I don't know if robots will cost as much as a car. Probably will, though, I imagine. So basically, so you won't need the car anymore because you'll have self-driving cars, and you'll just get in the car whenever you need one. But instead, you'll have a robot, and your robot will get in a self-driving car to go do your shopping for you, while you go in another self-driving car to go have fun. So either way, cars are going to still get used, and robots will get used. So it's going to be good for Toyota and Honda long term. So this is a pretty good basis. 110 line, very, very unlikely to break the 200-day moving average of 110. And that means obviously we could construct a play on Toyota, who pays, if I remember correctly, they pay a nice dividend. Or does nobody pay a dividend anymore? I don't know what's going on. Yeah, 3.6%. That's a good dividend. So you can own them. But it is an expensive stock, so I'm not super keen to own expensive stocks. I mean, I'll own expensive stock if it gets put to me. In other words, if I'm going to sell the puts, which means I'm promising to own it. So, options only go out to April. Oh, that's annoying. All right. So you sell the 100 puts for like 230. Okay, so sell 100 puts for 230, and buy the 100 calls for 17-ish, let's say 17.30, and then you sell these guys for about $7, 115. So you have the 100, 115 spread at just around $7 or let's say 7.50, so half. And then you sell the 100 puts for $250, so then you're into net 5 on a $15 spread, and you make $10 if they hold 115. There's two things that can happen: either they hold 115, and you make $10, or they drop low enough that you get assigned at 100, and you're into net 105, so you save $10. So you're either going to make $10 or save $10 on this trade. Those are your two possibilities. And then once you're in Toyota, then you would then sell the calls against your stock to lower your basis further. So let's say you're in a net 105 and you sell some calls for $7. That drops your basis down to 90-something. So the real question on this trade is, do you want to own Toyota for $90? You know, $95, whatever it is. And if the answer to that is yes, because don't forget this is only a 6-month sell, so you can do this every 6 months and drop another 5%. So if you don't mind owning Toyota for $95, this is a great trade. But that's why it's not in our portfolio, because this is too short term. It's not very sexy when it's that short term. We used to have them. I think they used to have longer options. News, right? We're doing news. Hang on. Oh, why did he reset me? Here's why I like reading the news, because it makes me think of, like, sometimes something hits you and you're like, oh yeah, that's important. Auto sales, right? Simon Property. Beat and raise guidance, really? Wow, that is impressive because they're mall guys. At issue, same store net operating growth, weakest print, raise eyebrows, what? Why are they talking about Mizzou? Oh, okay, same store net. What do I mean same store? Am I confused? Simon Property Group is the guys who own malls. Huh. All right. Anyway, my impression is it's interesting because I would think malls are doing terribly, but I guess they're figuring themselves out. Comcast minus 2%. Consumer goods gainers and losers, don't care. Apple's Q4 earnings we know about. Costco guy cares. Deutsche Bank's got earnings tomorrow. That's a big deal. They could kill the whole market tomorrow morning with Deutsche Bank's earnings. Hanger Factory. Goldman sees solar. Goldman sees most solar. That goes back to that SunPower thing, right? Sunrun is a top 3 idea, but most of them are going to miss their earnings. That's interesting. They mentioned SunPower. Neutral ratings for SunPower. Okay, so they think like I did that SunPower is beaten up enough. Sunrun with a buy. What's your problem? Extends challenging setup to stock. It is tough for the solar companies. So first of all, Solar City is killing everybody. And they're not making money. They're just doing stupid stuff that ruins the pricing for everyone. Oh, and Hyperloop. I read an article that said Hyperloop is like way, way over budget, and they ran out of money, and they have to raise more cash, and nobody wants to give it to them. Blah blah blah. It's not. I mean, it's not. You know, technically, it's not Elon Musk's company, Hyperloop, but it's his idea that these guys scammed a bunch of people into investing in it. Now it's like falling apart already. So very interesting. All right, well that's it. So basically, the only thing I would really pin this on, assuming that they're not missing any news here, is the auto sales. And frankly, that auto sales is not a good enough reason to sell off because it wasn't adjusted. So knowing that, now let's take another look at the charts. Here you go. Let's take the Russell. People see now we're turning back up a little bit. Probably because I'm talking about it. Let's see. So we get to the Russell trade, active trader. Russell, yes. Okay, so we buy some Russell longs. Here's one. Let's do two. Thank you. All right. So now we have two long Russells, and we're going to play for the bounce. Okay, so we're going to assume everybody bounces. Plus 1,200 is a nice bouncy line anyway. So as you can see, this is oil is bouncing back a little bit. The NASDAQ is bouncing back a little bit. Not much, though. Now, what we got to watch for is weak bounces. So from 1225 to 1200 is a 25-point drop. And so that would be a 5-point bounce, would be a weak bounce. But that consolidated down here and then today. So let's say it's only a 15-point drop. So we're going to look for at least 3 points here. And if we fail at 1203, that's bad. So there's two sets of lines we're going to use. The first week bounce is a 5-point bounce. The second week bounce from today's intraday is a 3-point bounce. But either way, we expect a bounce. All right, so let's think about what we did. We read the news. We then think about why the markets are down. We decide that it's not a good enough reason to break through significant resistance at 1200 on the Russell. So we go to the Russell and we take a long poke and see what happens. If we do fall below 1200, if the other indexes start looking weak, if 2130 here doesn't hold up, and now let's stop watching oil because we don't really care about oil, but we care about the Dow, which is YM, and we have the NASDAQ. So now we want to see if the Dow can get back over its 18.1. We want to see the NASDAQ make a little bit of progress here. And we want to see how we do over here, and we'd love to see the S&P over 2130, which it is at the moment. And this is another good line that we could play is 2130 on the S&P, but I got two of these, so I'm good with this one. But this is another good line to play is 2130. Any line where you have a really good tight stop below it, you can say, okay, if 2130 breaks that significant, and I can get out quickly. Okay, and one of the reasons is because 2130 is not likely to go boom and fail immediately. It's usually there's going to be like pokes below it before it really fails. And that goes to 1200 too. Any big line, any big number like that, a nice rounded off number on these indexes tends to give you a little bit of extra support. In fact, on the NASDAQ, you can see 4840 is where we bounced. And on the Dow here, it's 18050 is where we bounced. So, those 00 lines or 50 lines, you use your head, but it's going to be some rounded sort of spot that we're going to bounce from. So the Russell is having trouble getting back over this green line, which is support. But it's, so we'll see what happens. But we need, obviously, if everybody's having trouble here, then these might just be weak little bounces that aren't going to last. But what I know so far, in fact, keep it down. So what I know so far, though, is it seems like we're only down because of an order report, and realistically, that order report the headline doesn't match the facts of the order report. There were 2 less days. Okay, so when you have or anybody who runs a business, if you ever run a business and they say, well, how did we do this month? Oh, we did this much, and you say, oh, that's terrible. Like, well, there were 2 less days in the month. Like, oh, okay. It's like you got to compare things evenly. So that's our play for today. We're going to go long on the Russell, and I've got 2 contracts long, and we're hoping for at least 1203, which would be a $600 gain. That'd be nice. And hopefully, if it goes much below 12, we'll get out with a small loss. That's all. So we shall see what happens. Meanwhile, now let's see if anyone has questions. Sonic, trade 1031. Okay. 2 contracts sold that weird place. Yeah, I would think so. I can't believe that filled it all. It's such a weird thing. Robots, what companies are the future trades? Well, like I said, I mean, look, Honda and Toyota are heavy into the mechanics of the thing, but IBM, obviously with Watson and all that, if you pay attention, you'll see IBM creeping into everything. Okay, it's, you know, look, people talk about AI, and they say, oh, well, Microsoft's got Cortana, and Apple's got Siri, and somebody's got something else, and it's bullshit, okay? Go put Siri on Jeopardy. IBM put Watson on Jeopardy 3-4 years ago, and it beat the world. It didn't just beat a person on Jeopardy. It beat Ken Jennings, who was the greatest Jeopardy player, basically, of all time, and it kicked his ass. Okay, and it's completely different. It had to listen to Alex Trebek ask questions and figure out the category and understand the context and the nuance. It's nothing like Siri. Okay, that's like try asking Siri, even though you have to say, hey Siri, instead, and do that stuff. But try asking Siri, like, what's the best movie for me to see right now? Or you know, or where's the restaurant where I can get vicious swap? You know, it's not going to frickin' know. They won't even understand it. I don't understand the question. Watson is sitting there answering the goddamn question. Okay, so it's so miles above. Oh, by the way, I don't know about you guys. I get frickin' AI calls all the time now. I get these stupid sales calls on the phone, and it's these goddamn AIs. It's so funny. I have fun seeing how smart they are, but it's interesting because they all, more and more, they're starting to have these robocalls that go to you, and the initial call is they feel you out with a robot, and then if you answer enough questions that make them feel like you're a good prospect, they flip you over to a live salesperson to close it. All right, but it won't be long before the robot handles the closing. What do you need the salesperson for? So, unfortunately, though, it's got to be stopped because, right, I mean, frankly, you know, because if robots can sell you timeshares, then you'll just get called 24 hours a day by robots because until you break down and buy timeshares just to make them stop calling you. Because they're getting better and better and better, and they're going to collect the bills. And God forbid you owe anyone money, and a robot will call you every 5 minutes to ask you if you know, to say, "Where's the check? Where's the check?" But these aren't simple robots. I mean, these are, you know how it's like a voice prompt. So they call you, and it's like, "Hi, it's Wendy. How you doing?" And it's like the robot, and it's like, "Hi, it's Wendy. How you doing? I'm calling to because you have you've got an exciting opportunity to go on a vacation here and here." And I'm like, oh, hi, Wendy, how's it going? And she's like, oh, it's going great. And she'll start answering questions like that. And you have to go out of the field. So she asks you a qualifying question, like, you know, it's like, oh, do you own your home? And I say, yes, I don't. Yes, this is my domicile. And if you start saying things like that, they get confused. You know, because it's not on their script. But as they get smarter and smarter, you know, as they get more like Watson, they'll start understanding domicile means home. Therefore, you gave them an affirmative answer. And they're going to move on to the next part of the script. But it's amazing because they sound great. The sound on them is fantastic now. You really can't tell if they're human or not. You have to like really wait for them to trip themselves up. So that's it. It's the future, and really IBM is so far and away ahead of everybody else. It's not even a race. So IBM, fantastic investment. They're a great company all around. They've got plenty of things going on. They're huge in the cloud. And they are where right now? We have, I hope we have some IBM. I think we do. What happened? IBM back here was the runner-up for stock of the year. We were between natural gas and IBM. And what happened is when we picked it, it was Thanksgiving, and IBM was up here, and I was hoping it would be lower. And by the time we got to January, though, I said, you know what? I said, frankly, had IBM been here, this would have been my stock of the year. because I called 150. That was my call for IBM. So from 120 to 150 was a nice gain, especially when we could run an options play on it. Now, at 150, this is exactly where we should be with IBM right now. But at 150, if it goes to 140 even, I'm going to be really excited to get into it and buy some. Even here, though, if you're looking for a long-term play on robots and you don't have any IBM, I think that's a good way to go. Now, that being said, do we still have it? Because I think we cashed out when they had a nice run. Wait. I'm sorry, I don't know how to use this mouse. Long-term portfolio. What was that? The options opportunities. Long-term portfolio, 115%, all is well. Okay. And do we have IBM? IBM. We do. Okay. So you see, we started this thing. We sold these puts on 9/24 and 15, and then we added the spread when we had a good price here. So we went for the next year 140, 165 spread. We sold the 105 puts when they were a lot better pricing, and we're pretty well ahead on this one. It's obviously it's looking on track to make our money. I think there's another IBM play we got out of at some point when we had a big run. I remember getting out of something. But so this is the kind of trade we like. We sold some puts, we bought the bull call spread, and that's where we are with IBM on that in the long-term portfolio. This trade, if all goes well, will pay back $25,000, and our initial entry was 19 minus 7 is 12, minus 9 is 3. So our net on this is like $3,000-$4,000, and it's going to pay us back $25,000 if it goes well. That's nice. It's already at $12,000, so we're already like up 300% on this trade. So that's what I mean. Our trade of the year, the whole point, the trade of the year, when we pick a trade of the year, is we're looking for something that's going to make at least 300% 2 years out, not 1 year out, but 2 years out. We're looking to make 300% to 500%. And it's not just that we can make 300%, it's the safest, most likely way to do it. So in other words, the stock, we're not worried about it going down. We have an extremely high confidence it's going to hit our targets, and it's going to make a really good return on cash flow, 300 to 500%. And that's what qualifies things for the trade of the year. And so IBM came in a very close second in natural gas. And IBM, I still love it, and I still think it's going to be, you can play it every year. It's probably going to go up consistently 10 to 20% almost every year moving forward for the decade. So really, really good stock to play, especially when you use those kind of strategies. Wow, look at the options. Look at the long-term portfolios. We have 21 puts, 11 dividend players, 1 spread, doesn't matter, and then we have 17 custom spreads, 17 option spreads. But we never touch it. They're long-term, that's the whole point. See, it's okay to have a lot of positions when you don't touch them. In the more active, in the options opportunity portfolio, which is also up 116%, so it's about the same, we have more of a mix, but we have mostly these option positions. There's 19 of them. So we have 19 of these, and then we've got 5 short puts and a few other things. So, like 25, 30 positions. No IBM here, I don't think. No. Well, we're in pretty good shape. It's good, and this one is self-hedging. Then we have the short-term portfolio, which hopefully is doing well. Yeah, see, it's getting back to 400%. So that's nice. It was like at 370-something, so we're up like 20% on the short-term portfolio, which is $20,000 on this little recent market dip. So that's a good thing, especially because the long-term portfolio isn't losing ground. So, again, we're in a really good sweet spot here. We're not making a lot of money, but we're grinding it out every month because all the short premium we sold is working out. And the portfolios themselves, though, are very well balanced, the short-term and long-term portfolios. And the butterfly, well, you know what? You can't even use the butterfly portfolio. I have not finished these. That's wrong. I didn't finish making adjustments, so some of these things are wrong. It's so smart in here because it's very tedious, and I haven't gotten around to it yet. So I'll have to fix that so we can figure out what the butterfly portfolio is actually doing. But it's doing well. It's just not that well. All right. So How are we doing on time? 2:30. Okay. When was the trade roll posted? I don't know. The day of the earnings, 25th, right? Yeah, the day when the earnings came out. That day later, we decided to do it. My trade was at 10:31. Got the fill and 2 contracts. Okay. Natural gas suddenly popping. Yeah, well, it was getting. I mean, it was low. It's. Oh, I forgot about that. Okay. So we're down a bit. Let's see how NG is doing. We thought it was going to bounce at low. Oh, this is the it's a November contract. Holy cow. NGV 6. Yeah. So we had a little bit of an overshoot, but this is what we were talking about. Yesterday we were saying if it's bouncing between 3 and 304, that's not going to be good though. We need to be back over this line. We need to clear 305 because anything under 305 is really a bearish consolidation for more downside. So be careful. Anyway, so this guy's not working out so well. So the question now is, all right, now, do I want to leave this open if it's not working out? And honestly, I haven't given enough time to say it's not working out. I want to see it into the close. But I don't think anything's really going to change my premise that quickly. Monster, Citron, GE, Elio. Oh, Elio. Wow, that's a new car. Oh, I love them. My daughter wants one. 3-wheel vehicle, 84 miles a gallon. They've raised $96 million, and they want to get more money and advice. Yeah. I'm going to check this out. elio.com. What happened? Oh, I guess it's not it. Elio Motors. Oh, ElioMotors.com. There you go. Isn't that cool? So, it's a 2-seater, but one behind the other. It's basically a motorcycle enclosed. That's what it is, more so than a car. It's weird, they advertise a smart car on the site. Anyway, not to make a whole thing about it, but it gets like 87 miles a gallon, and it's cool because it's very customizable. Hang on. Customize. See, my daughter's, she is an artist, so she likes, there you go. My daughter's an artist, so this really appeals to her. Plus, she's being practical. She's like, I don't really need a car. She only barely needs a car. And so basically, this is perfect for her because it's cheap, and it's just going to get her around town, which is basically all she needs. If she needs a bigger car, she can borrow our cars. You know, but this way she doesn't have to. You know, she doesn't have to wait to borrow our cars. So anyway, you can look. I mean, look at the colors. You've got color palettes. You've got all these different choices: exteriors, interior design things, and whatever. But it's, look, for a first car, it's great. The only thing I'm concerned about is how safe it is. But I got a feeling, it's like a smart car. Smart cars are unbelievably safe. They have incredibly great safety records. So probably they do the same thing with a very, very tough cage around the passenger compartment, which protects the passenger, which is all we care about. Protects the driver. It's like those Formula One cars. They weigh nothing. They go 200 miles an hour, but they can crack up and smash into a wall and flip 20 times, and the guy walks out because the whole thing is designed to withstand the crash. That's how smart cars work, and probably that's how these guys are going to be designing it too. But I want to find out for sure. But meanwhile, it's cute and it's fun. And honestly, for the kind of driving, like my daughter, I'm telling her already, I'm like, you're not going to go on the highway with it. She's driving around town. But I think it's cool. Anyway, so that's interesting. Energy and materials on the hour, Verizon. Okay, now we're back to that. So nothing has happened. So there's nothing to change our position, nothing to change our mind. I still like being long into the close. I think we're going to snap back a bit. So we'll see what, oh, look at that. Whee! Aren't I glad I didn't change that? $200. All right, I've done my job. We're up $200. You see how working these seminars are? We had a great one last week. We have a great one this week. And that's it. That's how easy it is to make money, though. Read the news, think, make a trade. End of story. This is how we make our money in futures. And in stocks. It's just, it takes longer with the stocks. You know, it takes longer to be right in the stocks. And you have to start thinking, how do we adjust this, how do we adjust that? It's no different, though. It's just in the futures you get that kind of immediate feedback. But it's the same concept. We're just looking at the trends, figuring out what's going on, and trying to see where we can make the most money. Yeah, that's what I'm looking at, Randy. It's you know, for my daughter, all I care about is whether it's safe or not. It's like my only concern. It's like, if it's safe, sure. You know, but I live in a little suburban town where there's like not much traffic and you know, like she said, because she's like, she doesn't want to get heavy into a big car. And again, I don't know these things. I'm not an expert. It just seems like a cool thing. So I'm entertaining the concept. I mean, until there's like a one I can go kick the tires and take a look at, we won't know. But again, it's not going to be worse than a motorcycle for getting around. And again, and also, it's like I would not recommend it for your only car, but since it's exactly for what my daughter needs, which is she just wants a car she can tool around in, that she doesn't have to constantly have to borrow our cars. You know, because I'm like, how many cars do we possibly need? But she wants that independence. So this is I think a good interim solution, especially given where we live in a fairly suburban area where it's not a big deal to have a little car like that. But we will see. It's the future. I think everybody's going to have those at some point. Anywho, all right, so I'm going to start wrapping this thing up. So if anybody has any last-minute questions, ask them now. And let's see how the charts all look. All right, up and up we go. Oh, we talk about natural gas. They had a nice talk. See, I think maybe today was the last day of that contract. I guess it was because it's moving today. So today is the last day of the November contract. And I guess part of the sell-off was people dumping the November contract, and that may have been the drag on natural gas today, the particular drag on natural gas today. I am, you know, I look, if it's going to be bottoming here, I would certainly say on the NGZ6, if we can get back over that 305 line, I like it long there and just keep a tight stop below the 305 line. And if we come back and test 3 and that holds, I like it over 3. I mean, I said this yesterday, I like natural gas anywhere around here, and if it drops to 260, I'm happy to buy more. If it drops to, like I'm thinking, if it drops to 260 so fast I can't stop out, I don't care, I'll just buy more. I firmly believe that we should be up at $3, $4 over the course of next year. So I will just keep buying it long and taking all that money. Oh, and speaking of long things, where's my coffee? Coffee. Okay, we'll get rid of Apple and look at coffee. KC. Ah, look at coffee. That's my other favorite is up here. It's coffee, which I just talked about today in the post. I'm not going to go over it now, but I freaking love that. So this guy into next year, I love it. This guy into next year, I love it. These are two things we're going to be focusing on the whole time. I don't love the indexes, obviously, for long. So when they have a silly sell-off based on that order report that was ridiculous, if you just understand how a calendar works, I really don't understand people. I don't know how you can trade. I don't know how people can sit down and trade with their money and not be bothered to educate themselves about what they're trading. And just listen to like these fools on television who don't know anything. If you don't tell these reporters that, they wouldn't know. They only know what somebody like me tells them. That's all they ever know. People call me all the time asking me what's going on in the market, these reporters, and then they write down in their articles what's going on in the market. But only because I told them what's going on, not because they know. And the guys on TV are the same thing. The guys on TV have some guy who called me whispering in their ear and telling him what it is. It is so ridiculous. It's like they don't do their own homework at all anymore. And less and less. In fact, there's an article this week about the Wall Street Journal is laying off a huge amount of staff. Barron's laying off a huge amount of staff. They're outsourcing more and more to the AP and things like that. And the AP and Reuters are outsourcing all their stuff to India. Half the phone calls I get now are from guys in India who ask me questions from Reuters and AP. I mean, that's just crazy. Those guys don't know anything. These guys literally graduated from call centers. They have like guys who speak good English from call centers are the ones that they're using to call and talk about finance. Not because they're good at finance, just because they speak better English and they can understand at least the nuances when I'm talking about something complicated. But that's what it takes to qualify to be the AP and Reuters reporters now. It is scary, scary stuff out there. So be very careful what you read and listen to. There's a lot of idiots out there doing idiotic things. But that's great for us, though, because we catch things like this and we realize there's a complete mismatch and it's easy to be trading against. You got to love that, right? So how we doing? 260. Oh, I really feel like I did my job today. All right, 260 and going strong. So now I would put a stop on at least one. If we go back to 200, I would put a stop on one, and then the next stop would be at 50, so we lock in a $150 gain, but still give ourselves some upside. All right, so that's how I play that going forward. But I think, like I said, I think we're going to hit 203 at least, and that's going to be a $600 gain on that set. Russell turning bearish. Would I buy? Wait, I'm getting confused. 69 Chevy Camaro, blah, blah, blah. We have a 68 Mustang. I love that car. We're up turning bearish. Would you buy SRTY? I don't know. Would I? I like TZA better. It's more liquid. Look, for me, it's if they don't have good options, I don't play them. So, and TZA is a hedge that we have. So let's take a look at SRTY. You see the problem? It only goes out to January, and the spreads are, well, they're not even trading. I mean, look, nobody's even trading these things. They're not even going to last. So very, very thinly traded, huge wide spreads. So I would not play it. But TZA, and by the way, it's not just because it doesn't have options, but if the options aren't even trading, then it's not very liquid. TZA, on the other hand, is a very liquid thing. You can go out. Oh, wait, they go out further in January. Yeah, they go out to 2000. They go out to 2019. Not that they're actively trading, but the point is they're there. Still pretty wide spreads when you get that far out in time, but generally, if you're in January, let's say, these options are at least trading, and you can see where the prices are falling between, and so on and so forth. And TZA is just as good. It's at $30, so you can play it the same exact way. It's just an easier to fill, more liquid position, and you can play options on it, which makes it way, way better. TZA is one of our primary hedges, and where would that be? That would be in the short-term portfolio. And what do we have? We have, here you go. We have the 2018 25 calls covered with the 2017 $40 calls. Now, when these expire, they're $10 out of the money and they're still $1.25. When these expire, we'll sell something else for a couple of bucks and lower our bases. And then we have some of these short. Wait. Oh, I'm sorry. We already did cover it. We have the 2019 25-40 call spread. See, we sold these to 550. These are going to expire worthless unless something weird happens. So the net is 9 minus 190 minus 550. So minus 750. So basically, we paid $1.50 net for these longs. How's that? So, we paid 9, so we wrote, buy these for 9, we sold these guys, and we paid net $1.50, we're paying net $1.50 for the insurance on this position, which is deeply in the money. So the only way we can lose is if the Russell makes significant progress up, and if the Russell makes significant progress up, then our longs are going to do well, and then we don't need the insurance. So it all works out. So tomorrow's the last day. Is tomorrow they're still going to trade it? Really? Okay. The ETF, it doesn't particularly roll over, but they roll over their contract internally, and that then generates fees, which then lowers the price of the UNG. But either way, then this is a good time to go long on UNG and on natural gas. And Randy's been enjoying himself, so that's a good thing. All right, guys, so thanks for coming. It's been fun, and we will do it again next week. And that's it for now. And, we'll certainly be throwing out some more trade ideas in the chat room. There's lots of fun stuff to do, especially if natural gas is turning around. We'll come up with a couple of new plays. All right, but have a good day, everybody. Thanks.